Hello and welcome to BQ Prime. I'm Hiral Tadia. CCL products, one stock to focus on in today's session. Revenues have seen a growth of around 38%. Profits have improved by 62%. There has been some bit of pressure in terms of where margins go, but what's leading to that? Joining us on the show to discuss more is Challa Srishant, Managing Director at CCL Products India, joining in. Srishant, good afternoon and welcome to the show.
Thank you. Good afternoon.
Srishant, overall, what has worked and what has not worked according to you, and has it met your internal expectations if you have to look at the fourth quarter?
So we were completely in line with whatever we had projected at the beginning of the year as well. So we were expecting our additional capacities to come online in quarter four, which came online as expected. And whatever numbers that we had projected at the beginning of the year, we basically hit the same targets as well. So there were no surprises, either positive or negative. There were no surprises. So, yeah.
Right. So how is the volume panned out? Because in the previous quarter as well, we did see the volumes falling to single digit, but that was obviously on the back of the 20-day maintenance shutdown we had undertaken. How has that been in this quarter?
So this quarter, the volumes were back to our normal. In fact, we've had some higher volumes because of the additional capacities coming online. There's a little bit of outsourcing also that we had to do to execute our existing orders. So whatever we normally track, whatever we do on an annualized basis and more than on a quarterly basis. So on an annualized basis, we had projected a 20% volume growth, and that is exactly what we have achieved.
Right. But I think the range that we were looking at was around 20 to 25%. So is this still on the lower end? I mean, any reason why we've not been able to get to the 25% mark?
So normally, if it's when we say 20 to 25%, we are actually ending up at about 21.8% or something like that, to be precise. So it is within that range. Again, customers, sometimes they ask you to dispatch certain products at a certain time frame. So there could be some spillover into the subsequent quarters as well.
Right.
So when we broadly give our indication, we look at the order position and what we are likely to do. So that's why our indication typically has been in and around 20%.
Right.
So even for the current financial year, that's the same guidance that we have given. So around 20% plus or minus.
Right. And apart from that, you mentioned about the additional capacity as well that has come on stream in Vietnam. What's the current utilization, and how much do you think we will be able to scale it up to in terms of FY24?
So in the current financial year, the additional capacity, we are looking at around 50% utilization. And over the next couple of years, we are expecting to, over the next 3 years, it should go up to about 85% or so.
Okay. And in terms of the price trend and realizations, how is that panned out? Because clearly in the previous quarter, we've seen realizations improve, which optically actually drove our margins lower. But this quarter, how is that scenario looking like?
So one good indicator to track our company is looking at the EBITDA percentage increase. Because of volume growth and our EBITDA growth will be directly interlinked. There could be 1 or 2 percentage points variation because of various factors, but it's largely interlinked. The actual top line growth is not a very good indicator because the top line actually depends mainly on the raw material prices, which are currently at an all-time high. So at this current $2,600 per ton levels, this year also, we are expecting that top line to grow a little bit more disproportionately. It won't be at the same 40% that we saw last year, but it will definitely be more than the 20% that we are currently seeing as our volume growth this year.
Okay. And again, from a business perspective, how is the order book looking like for FY24 and 25?
So typically we have a good visibility at least 1 to 1.5 years in advance. Current situation is a little bit of an exception where we have certain orders confirmed up to 3 years in advance.
Wow.
So almost about 20% of our capacity has already been booked for 3 years in advance. And for the current financial year, I think around 75 to 80% is already confirmed in our books. There's only a balance gap of about 20% left for us to fill. And next year, we've actually started selling for next financial year already.
So overall, would this actually translate into in terms of additional capex? Because I'm sure that would be the need of the hour as well. So what is the plan on that front, and how are we planning to fund the capex, if any?
Yeah. So last year, we've actually initiated this very aggressive capex growth phase. And the stage one has already been completed. That is our Vietnam expansion. So now from 13,500, we've gone up to 30,000 tons in Vietnam. In India, we are increasing our spray dried capacity by an additional 16,000 tons. And in Vietnam, we're adding a freeze-dried capacity of another 6,000 tons, which will come online next financial year. So with this, we would have doubled our capacities after these two capacities come on stream. And we'll be good for the next at least 3 more years after that. We'll be able to manage with these capacities.
Right. Another angle I want to explore with you over here is that overall, with all of these capacities coming in on stream, the FDC mix is something which will increase as well, right? And the volumes coming in from Vietnam will also increase. Does that actually bring us to a lower overall tax rate, which will then aid profitability?
So one, we have actually expanded more on spray dried rather than freeze dried.
Okay.
Our freeze dried expansion is only about 5,500 to 6,000 tons. But our actual spray dried expansion is now, considering Vietnam plus India, what we're looking at is a 30,000 tons increase. So spray dried is where we are increasing substantially. Freeze dried, we are increasing only marginally. And because Vietnam is in a tax-free zone and the spray dried expansion took place in Vietnam, we are looking at a tax benefit coming in as well, which is why we're expecting the bottom line growth also to be a little higher than the EBITDA growth.
Right. And overall, I mean, to what I understand is any coffee price inflation is not something which impacts our margins, because that's something which is a pass-through as well for us, whether increase or decrease. But do we see, I mean, what is the trend looking like, and how is the impact specifically from a revenue perspective then?
So from the revenue point of view, in the current financial year, we are expecting an increase to be there compared to the volumes. So because the prices also have gone up, last year we were looking at around 2,000 levels. Now we're seeing 2,600. So we are expecting an increase to be there. The next year, again, is dependent on how the prices shape up. So it depends on when we confirm our orders. So we won't have that kind of visibility until at least the next few months pass.
Right. And again, from a sales perspective, we are seeing higher share of small packs as well. And that's usually the trend when we see specifically with FMCG players or consumer products. Clearly, do you think that's something which will help us aid our margins as well and help us improve our EBITDA per kg?
Yes, definitely it will. In fact, it's also going to enable customer loyalty. When we do specific blends for brands, then you don't have flexibility to transition from the supplier very easily. So this is one area that has been a focus for us for quite some time. And our volumes also in the small pack segment have been increasing accordingly.
Right. And very lastly, in terms of the capex, how much are we spending? If you could give us that number, and will that be through internal accruals or will we be raising debt? And how are we looking to manage our FCF?
So we are looking to spend an additional about 400 to 500 crores. And we are doing about 80%, which is through debt, and about 20% through internal accruals.
Okay. And how does that actually change the FCF? Because from last year, yes, the free cash flows have doubled, but there is some bit of pressure that continues to remain there as well. So I mean, if you have to take the full potential of the capex to start flowing into the FCF, how is that matrix looking like?
So that is something which will still take some time. But today, with the kind of green coffee prices that are there is pressure on the working capital as well. In fact, one of the biggest strengths that the company has is that we are able to get very good interest rates. So sometimes it makes sense for us to block our working capital to procure the raw material because it's back-to-back orders. So there is a advantage that we get for blocking our working capital. Otherwise, we'll end up paying a premium. So we manage our cash flows also accordingly. We make sure that we are operating at optimal levels at any given point in time. That's one reason why we've given a clear guidance also for the next couple of years. We're not we are also paying out dividends and everything. We haven't changed our policy in any manner. So keeping all these things and outflows and everything in mind, we are not looking at any significant change in the free cash flows for the next couple of years at least.
Right. So I think that's going to be a key monitorable as well. But great expansion plans that we are looking at, and the translation of that in terms of revenues is going to be crucial to watch out for. Thank you, Srishant, so much for joining us on the show and having that candid conversation with us. Looking forward to the newer businesses that you're looking to enter as well. Though the mock meat business, though we know, is still a very small portion, but I think in the coming quarters that will be something to talk about as well. Thank you. Stay safe and speak to you soon again.
Thank you.